Hi, everyone. Welcome to the show. I'm your host, Jason Nadek. There are two words that can pique the curiosity of many option traders: implied volatility. It tends to rise when uncertainty is higher, and where there's uncertainty, there's often trading opportunity. Well, major market events like central bank policy announcements and corporate earnings reports can be magnets for higher volatility. So, traders might want to trade options around them. Now, of course, the heightened uncertainty can also carry much higher risk, and trading these market events can be anything but straightforward. But fear not, we have an experienced option trader here to share his approach and some key considerations to keep in mind. Joining us is Ben Gossack. He's the managing director and senior portfolio manager at TD Asset Management. Ben, thanks for being here with us.
Great. Thanks, Jason. Thanks for letting me come on board and talk about options.
Yeah, really glad to have you here. I know the audience is going to be able to learn a lot from your experience. Now, before we dive into our conversation, can you maybe share a little background about how you use options in your role here with TD Asset Management?
Sure. So we run two enhanced dividend mandates. One's global, one's focused on the US listed stocks. And essentially, we own quality compounders. Typically, they benefit from their cash flows compounding, and some of them will pay dividends, and that's where we'll collect income for unit holders. But then we try to enhance that income by writing a lot of calls and a lot of puts. And so there are at least 4 opportunities in the year, especially when it comes to earnings season, which is one that we just completed, where we have targets that we want to hit for income each year. So I do look forward to market moving events and earnings report. Sometimes it might be an FOMC meeting, so a meeting of a central bank, where we can look to achieve additional premium, additional income, because we're always trying to sell implied volatility to generate an income stream all throughout the year.
All right, that sounds very interesting, and I'm really looking forward to unpacking that as we get into our conversation. All right, now first off, how might options with their market dynamics and how might they differ around major events and upcoming corporate earnings reports compared to everyday conditions?
So I think if you look at a stock, if there are no events, no catalyst, it has an inherent, let's say, path of uncertainty. So, and that path of uncertainty for a stock will change depending on the kind of company that it is, or the cash flow characteristics, or its corporate strategy. So that's what we call implied volatility. And so there is that implied. Each stock will have its own sort of natural implied volatility. There's a mean reversion to it. When you add in a catalyst such as an earnings event, sometimes it could be the company's going to have an investor day. So you might get a new strategy update. Maybe the chief financial officer is going to tell you about a new sort of earnings forecast. Or in the instance what we've been facing, I'd say for most of the year, a CPI report, so a report about inflation, which could have implications on future rate hikes, has also had implications to where stocks could go. So all of that has heightened the uncertainty, and so that's why you have to be cognizant of these dates, and if you want to take advantage of them, or if you want to avoid, because you can run into a lot of risk when you approach these events.
So why might an investor consider trading options around major market events like interest rate decisions, those CPIs, corporate earnings reports?
Right. So, and I think it has to go back to your strategy. So if I were to take it back to our strategy, we're a consistent seller of implied volatility. I would say, we're a consistent seller of uncertainty. So for us, what that means when we get into an event where, the path of a stock can go this way or this way, it creates an opportunity, Jason, for us to create more income than we normally would get during a period where there is no catalyst. Some option traders or investors might look at catalyst as an opportunity to go on the other side, buy implied volatility, buy uncertainty, saying that it's mispriced. So there's 2 different ways to go about it. I wouldn't just look at a catalyst, let's say, a future central bank event, Maybe, a big topic du jour is the debt ceiling, and try to, say, wow, there's uncertainty. Let me play uncertainty. I think you have to know exactly why you're there. You have to develop a strategy for it. And you have to know whether you're getting a good deal.
So, speaking of risk, let's unpack that a little bit. What are some of those potential risks involved with trading options around major market events and earnings reports?
So the biggest risk, Jason, that I see people encounter, and the reason why I say they encounter, I've encountered them all myself. That's why I've got my gray hair and wrinkles. Um, is when you misprice the market. I've seen this time and time again. You might have a company, an event happens. So I don't know, let's say um, the company misses, or just really executed in a wrong manner. And so the stock just drops, and all of a sudden it starts to feed on itself. And people think there's easy money to be made, maybe by buying puts. So, trying to say, make money off the fact that they're going down because they see it going down. I would argue many times the option premium that you're buying has already factored in that type of movement. And so you're going to see the stock go down, and you're going to wonder why your option premium is not going up. So the first rule I'd say is, whether you're going to buy a call, buy a put, that type of side of the market, is to understand whether you're overpaying or underpaying. And that typically goes back to sort of implied volatility. It's kind of one of these things where I could teach you how to swim on land. It's a whole other thing, Jason, once we go into the water. And one other thing that I couldn't recommend anymore is like, keep a good note, keep a good logbook. So I mean, we have a book of record that keeps track of all of our options transactions. But even if, we might do, let's say, 3,000, 4,000 transactions a year, where we're writing calls, we're writing puts, we record everything that happened in the market at that point. So we know what our strike price was. We know what the option premium that we received, the price that we received. We keep track of the bid-ask spread at the time. We even reference where the stock was trading at the time. So I encourage people that it's really good practice and good hygiene to keep a log of all your trades, and that way you can go back and look at, okay, what happened.
Almost like a sports analogy there. Like, you've got people that analyze their golf swing and making sure that things are exactly where they need it to be. But the same thing from a trading perspective. Don't take those opportunities to learn for granted. So we have a kind of a broad kind of view of kind of where we're choosing our stocks from. But let's now focus on the options themselves. What are some of the significant factors that are driving an options value when we're trading them around market events?
Yeah, so I'd say, especially around a market event, the key factors to look at would be the implied volatility. So again, you would look at on a historical basis. You could look at that through the various option prices, and so there'll be different implied volatilities for different strike levels, but then different maturity levels. So we care about the implied volatility. And for us, what we do to make it useful for us is we take the implied volatility and we convert it to an annualized yield. So it's effectively, you take that option premium. If it was calls, you divide it by the current stock price. If it was for puts, you divide it by the strike price that you're focusing, and then we can have a discussion internally about whether we like that yield. So if I'm going to own an option contract and it's out for 3 weeks and I can get a 6% yield, do I want that versus something that's paying me a 3% yield or a 10% yield? We're still talking about implied volatility, but we've converted that into a language where we're just talking about annualized yields. The other thing that you would care about is maturity. So are you writing this option? Are you going to be holding it for a week, 2 weeks, 3 weeks, a month? I've seen people go out further. Again, it would go back to your strategy. If you're going out, depending if you're long or short that option, time decay, what they call theta, is really important. So if you're long an option, you're really going to worry about the theta and the time decay, because if your stock doesn't move every day that goes by, it creates more and more pressure for your stock to deliver that result, i.e., hit the strike price that you're looking for. And in each day that goes by, I mean, you really need something massive to happen to move a stock, let's say $5 or $10. And for us, since we're always short options, we want to write on the shortest amount of time period because that theta decay is to our advantage. So those are, I'd say, the two really important considerations, along with whatever the fundamental setup is for any particular company.
All right, great. So let's walk through your personal research process when trading options on market events. We'll use an example stock to help illustrate each step. The first step is understanding the macroeconomic and fundamental factors that might impact the stock. What are some of those that you would consider?
Okay, so one example I wanted to talk about was a large cap technology company. For us, what was really interesting going into earnings season was because it's a large cap tech company, they're really big in the cloud. And so, from a macro perspective, we've seen rising interest rates, slow down fundraising for many startup companies. These are the companies that consume a lot of cloud resources. Um, Companies are rationalizing and optimizing their cloud usage, and so that's having an impact on the major, let's say, cloud technology companies. And so there was a lot of uncertainty as to that digestion phase. Another fundamental factor was also just managing expenses. For a while, companies weren't getting operating leverage, so they would see their revenue grow, but expenses were growing faster than their revenue, so they weren't seeing it on an earnings per share basis. And so you want companies that have operating leverage. So if revenue is up 5, you want to see earnings per share up 8. And so we wanted to see that come back for many of these technology companies. And so that was a big question. In this particular situation, it's not like another company reported ahead of it. So you try to triangulate, well, if company A did this, this is what company B would have done. In this situation, this was the first company to report. So that also created an opportunity because there was so much uncertainty. And then, however, that would work would set up all the other stocks to fall after it.
A bit of a follow up to that. We've looked to see what's coming up. How about looking backwards? Do you base any of your research on kind of what's happened in the past with these earnings and announcements from the government and things like that?
Yeah, so I think again, it goes back to the nature of each stock. So let's say you were to take a company, let's say a growth company, maybe it trades with a high valuation, and in typical fashion, you might expect that when they report, there's so much activity on both sides that they can move up 10%. Yeah, you would factor that in just as much as you would factor in there are certain stocks where even if they have an amazing earnings report, they beat, they raise, they take up guidance, naturally the stock will move 2%. And for that company, that might be a big move for that company. There are people that do this purely quantitatively, and that's fine. What we've tried to do is pair it with fundamentals as well. So we like to understand the issues, the concerns, the catalysts that are going on with the company as we come into an earnings event. So, what is the market worried about? What are the specific figures that the market might be looking for in terms of, it might sometimes you see a company that beats on earnings, that beats on margins, that beats on earnings per share, but not every number is equal. And so for us, it's really understanding what those numbers are, and then where the momentum or where the controversy or the debate, and then making sure that we're being compensated for those risks.
All right, so we've talked a little bit about looking backwards and seeing to and looking at past performance, but looking at our example company. Uh, what can we glean from the past stock performance that we can see on the chart around market events, and how might that be useful?
Right. So in the case of this company, it had an amazing um, year outperforming the market in 2021. Like most technology companies in 2022, it had a drawdown of almost 40%. Again, looking at past to future performance, a lot of the bad news has started to been priced in, and we saw many other tech companies, including this specific tech company, start to focus a lot of it on expenses. You could see that the company had sort of bottomed and had started to build up momentum. Again, we factor that into the fundamentals, and then you have to factor a layer again the technicals, and then you have to look at, again, from a compensation perspective, um, this is a stock that if they did report well, could gap up, could trade higher. And again, going back to our strategy, which is then to sell that implied volatility, make sure we size that accordingly. So we had to factor in the time, and we had to factor in the strike price. Conversely, someone else could take it from the other side and say, yes, momentum is building for this company. I want to own a call option and take advantage of this earnings event, and look at the same charts, the same fundamentals from their perspective, and say, I'm willing to buy the option premium, and hope that the stock moves more than what the market had priced for it. So you're really looking for an upside surprise. And so in the case of this company, it did have that upside surprise, Jason, and it moved 8%, and it did clear that resistance point that we had been watching, and actually expired maybe less than 1% away from our strike price. So in this particular situation, we had sized accordingly, and we were paid, from our perspective, 3 times more than we normally would get paid if it was just any given week. And we could have wrote our strike price even lower and gotten paid 5 times, 10 times the normal amount that we get paid, Jason. But again, it goes back to that would be, chasing for a few more pennies in option premium, but then having to give up that stock, and leave sort of 6%, 7% on the upside. Another thing that most people have to factor in is, yeah, you will see a lot of uncertainty. You will see juicy implied volatilities that lead to sort of juicy option premiums. You probably start to pre-spend that money. You're like, wow, an extra $3,000 coming to my account. What could I do with that? You have to understand, well, what are you leaving on the table and what are the risks? All of that has to factor in. Again, this isn't simple stuff, it's complicated. And so that's why, again, if this is of interest for anyone, understand what is your strategy, and then start small. And again, be curious and create, information feedback loops that get you more and more educated.
And something you said earlier in our conversation, I think kind of really relates to kind of what you just elaborated on around being right with the market direction, but ultimately being wrong in terms of profitability. So how might that play out in terms of the situation? You were mentioning someone going long with an option. How would that kind of scenario play out when you're being right, but ultimately being wrong at the same time?
Yeah, the case that really sticks out to me, it's a true story, but I read this news article about, um, let's say, hackers. And what was really neat about this story, Jason, is that they were able to hack into the newswire services. And I think there's only actually a few newswire services that have everyone's press releases. So they were able to see every corporate's press release before you and I saw it. They actually had the information, Jason. They could say, okay, company A is going to report this much revenue, this much margin, this much earnings per share, and they could compare it to what analysts were expecting. So they looked for big beats or misses, and they either bought calls or they bought puts accordingly. And the outcome of their results was just about the same as if we didn't have the information. It just tells you that even if you know exactly what the company is going to do, it's very possible that the market trades down or trades up. And so this is something that everyone's going to have to factor into their analysis. And yes, you could have done everything right. And for whatever reason, maybe it's something that the company said on the earnings call with the analyst. Maybe maybe the market just assumed that this is as good as it gets, and if this is as good as it gets, it can't get any better. Stock sells off. Or maybe you thought things were going to be bad, and they were bad, but it can't get worse, so it can only get better. And the stock trades up, and you were expecting things to go bad. So all I'm saying, Jason, is even if you have all the information, it still doesn't guarantee that you'll get the reaction that you're expecting from the stock, depending on if the result was good or bad. And so you have to size that into where you set up your strikes, or how you think about whether you're overpaying or underpaying for implied volatility, which is effectively uncertainty.
And so let's jump back to your own research. The third step you've got here in your process is examining the stock's technical trends. Which indicators do you like to use to help determine the potential entry and exit points?
Yeah, so in this situation, we would use charts. I'm very simple when it comes to technicals. I've met people who have, degrees and they're certified technicians. and they'll draw a lot of spaghetti on the screen. I'm a very simple person. When I dance, I'm just doing the two-step, and that's how I apply things with my charts. So I look for, let's say a support or a resistance point. And again, the reason why I care about that is because this market is very algo driven, and the algos were created by humans and they're looking at the same stuff. So it's very self-reinforcing. Sometimes it might be a moving average. Again, it's only because the market can be very self-reinforcing. The other thing that I'm very mindful of, and again, I don't know if it's done on the candlesticks. I know there's a couple of different ways that you can view stock and stock prices. Most people will look at it from a continuous basis. I would plot it based on seeing the highs and lows of the day and the open and closing prices, because that allows you to see where there are discontinuities in the stock chart. And I would focus on those discontinuities. There's this proverbial adage in the market that if there's a discontinuity, we call it a gap, all gaps get filled. It doesn't mean they should or would, but the fact that we say it will, algos, traders, everyone is going to eventually, probably on a self-reinforcing basis, fill those gaps. So depending on where we write those strikes, if we're close to a gap, our process would adjust for that.
And to our viewers, you can learn more about the ins and outs of technical analysis in our video course, Active Trading Intro to Technical Analysis. And make sure to give it a watch when you're in the Learning Center, on Webroker, or once again, if you're on TD's YouTube channel. All right. Now, what do the technical indicators suggest to you about our example stock ahead of its next earnings report?
So right now we've cleared a recent sort of resistance point. So as we're looking out to the next earnings report, again, it goes back to our fundamentals, but we have some more gaps in our chart. And so again, that could be fuel, that could be a magnet that continues to take our stock higher. As we write calls, because we're going to be out there every week writing calls, we're going to size accordingly and give ourselves some upside, more upside than we normally would have, because we're aware of those gaps. And again, the market can be self-reinforcing. They're going to try to see if those gaps get filled. And we already have positive momentum coming out of the earnings, which means fundamental managers, momentum managers, let's say retail are going to look at the stock and say, hey, that was a great earnings report, or that was better than feared. This is a great management team. They're executing very well. I want more of this company. And so that creates the momentum, and that's probably why we'll be very mindful of those gaps. And when we write our calls to generate that income, we're gonna make sure that we're always writing above the gaps.
And the last major step in your research process is analyzing a stock's options chain for clues about how it might react to major market events. And what kind of insights are we hoping to glean from the chain?
Yeah, and so a lot of it, again, if you're always writing calls, puts, or buying calls and puts, you start to notice just regular patterns, and then sometimes things act a little weird. I'll give you a couple examples. We were approaching in the earnings report for a major bank. So it's one of the first banks to report. Lots of questions about deposits and net interest margins and what is going on with this banking crisis that we talk about all the time. And so what we had noticed, Jason, what was unique to us is when we're looking at the put side of the equation, um, nobody was bidding for protection, i.e., there wasn't a lot of implied volatility, there wasn't a lot of activity, or premium being built up into the puts. And so our read on and what we took from it was not that that gave us information on how the bank was reporting, but more likely than not, it was going to be better than feared, and that we then, when it came to the call side, so how far the stock could go up, we even gave ourselves more upside than we normally do. And that stock was up, I think, 6 or 7% when they reported. So someone could have looked at that a different way and said, okay, let me buy volatility, let me buy calls and try to take a situation like that. In some cases, Jason, there is no earnings event, there's no catalyst, and things are looking a little weird. And in many of those types of situations, I'd encourage people is you don't have to play everything that comes your way. So you don't have to swing at every pitch. And there are many times where we step away and we say, that's interesting. There is some volatility, there's some uncertainty, but there's no event. We look at the calendar. Um, and so that's when we feel like we're at an information disadvantage. And so we'd rather sit and wait.
But yeah, I guess that's one thing to know. Even if you're very familiar with a stock and you've got a lot of experience monitoring something, sometimes discretion is the better part of valor, right? You can always keep your powder dry, so you've got an opportunity to react to the next event when you have more information. Companies often give a lot of advance notice as to when they will release their earnings report. So, what sort of time to expiration and expiration date might a retail trader want to consider with these trades we've discussed, in your opinion?
Yeah, so if you really want to focus on a market event, you typically pick the strike expiration date that's closest to that event. If you go out further, so you could say, I'm going long these calls, I'm going long these puts. You spoke about this decay in time and it's working against me. Shouldn't I push it out as far as possible? That way I minimize, how much I lose on any given day. And that would be the right rationale. But then you add, more days of uncertainty where, maybe there was again, an impasse on the debt ceiling, and that starts to factor into your option pricing. Maybe there was a change in interest rate expectations. So if you really want to focus on a market event, I definitely would pick an expiration date that would be closest to it.
We've went through many different fundamental factors as well as some technical factors. But what are some other considerations traders may wish to keep in mind when we're trading options around markets, events, and earnings?
If a company has a lot of short interest, um, that can be fuel that if they report something that's better than feared or even better than expected, you can expect it's like a whole bunch of people, trying to go through the door at the same time. Um, it could be hedge funds, it could be anyone that was short has to cover. And so if you didn't size accordingly, that could catch you on the wrong side. Conversely, that could be something you're looking for in an option strategy. If you wanted to take advantage of short interest cover, and we've seen that through COVID, there are many periods where companies went through this sort of short cover rally that could last, a day to even an entire week, depending on how much shares was out there and how much these companies were shorted. Every time that you're trading, you have these option makers that are constantly hedging their books. And so, depending on how they're hedging, you could get into a situation where there's a lot of interest around a specific strike price. And so, if it goes above the strike price, they're selling. If it goes below the strike price, they're buying in anticipation of, um, they're either on the right side from their hedge perspective, or on the wrong side. And so they're constantly moving and oscillating. And so the stock could just get stuck. And if you were long the call, long the put, that just takes out all the uncertainty. And those options will typically expire worthless. So that can be challenging.
Now, do you have any way that you would be able to identify if a strike price is more apt to be pinned or have pin risk?
So you might take a look at a given strike price and look at, let's say, compare the call open interest to the put open interest. And sometimes the delta, if it's quite large, that would tell you that there's a lot of activity at that strike price. And if the stock were to trade near it, again, these levels can almost become like magnets for a stock. That's when the stocks can get stuck. When they're stuck, it's really hard for them to move. And so, yes, if you were trying to take advantage where you were being long implied volatility, meaning you think uncertainty can grow wider, if you're getting close to those pins, those key levels, I would back off.
All right, we're going to have to leave it there, Ben. Thanks for filling us in on some of your considerations when trading options around markets and earnings events. Any final thoughts you'd like to share with our viewers?
Well, I love talking about options. I appreciate the platform. So I'm looking forward to people's questions. Again, trying to trade options is challenging, and then trying to trade options around market events is even more challenging. And so again, it goes back to starting small, having a process, sticking to your process, and then iterating. And if you see something and it looks too good to be true, again, you don't have to play every market event. It's actually quite difficult. So again, process matters, and that would apply even just for owning a stock portfolio or any other type of asset portfolio. Those who stick to their process tend to outperform in the long run.
Yeah, Ben, this has been very informative for myself, and I know our audience is going to get a lot of great information. So I'm really looking forward to the Q&A. So thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and as well on the YouTube page. We'll see you all next time. Thanks so much.